In this video, we're going to talk about Palantir, trading under the ticker symbol PLTR. Palantir is a data analytics company founded in 2003 and is headquartered in Denver, Colorado. It develops software platforms and applications to better understand data flow and optimize the operations. Palantir has an appeal for the market because it does have a solid reputation built in a relatively long time and has a lot of established relationships with major federal agencies and has obtained many long-term contracts as a result. It operates in many sectors including automotive, legal, natural resources, and finance. The platforms it develops are Palantir Gotham and Palantir Foundry. The trading volume of Palantir has recently been 35.6 million shares compared to an average volume of 37.9 million shares. Over the previous 52-week period, its price has fluctuated between $15.35 and $45. The market cap of Palantir is currently at $31.2 billion, compared to an enterprise value of $45 billion. The difference between the market cap and the enterprise value is the premium or discount financial market is willing to allocate to the company based on its current fundamentals, leverage, and asset composition. Some of the examples of impact by leverage is if the company has a lot of debt, then the market may feel uncertain or uncomfortable about the company's capacity to pay back its interest and principals, which in turn may negatively impact its profitability, attractiveness, and solvency. Another key element to understand is the asset composition of many companies, and it is especially true for growth-type companies. For many of those, one of the most significant assets they own is the goodwill. Goodwill is basically an expectation of the market that this company in particular is able to generate more profit or to have more growth than another company, partially because it has a good management, stronger brand recognition, bigger following online, and so on. In other words, it's not a tangible asset that companies can use. However, it's often the reason why some companies are perceived to be trading at a discount, because the market cap is lower than the enterprise value, which is the value the market is willing to give to its assets when the debts are paid off. In comparison to its historical price fluctuations, the stock is 4.3% higher than the 1-month low, 4.3% higher than the 3-month low, and 3.4% higher than the 52-week low. In terms of the options market, which often gives a hint of the market sentiment regarding where the stock price is likely going to head toward, the implied volatility is 59.3% compared to a historical volatility of 46.7%. The put-call volume ratio is currently at 0.75. The most recent volume of options traded has been 137,000 contracts within a day compared to the 30-day average volume of 176,000. In terms of open interest, the most recent volume of open interest has been 3.8 million contracts compared to the 30-day average of 3.4 million contracts. Regarding the shareholder structure, institutional shareholders own about 33.7% of all outstanding shares. The biggest shareholders include Vanguard, BlackRock, and State Street. The relevance of the shareholder structure is important here to determine whether you should be holding the stock long-term or to view it as a short-term volatility play. If the stock is mainly held by retail traders, then it may be a sign that the stock lacks the depth to justify long-term trust from shareholders. Obviously, there are a lot of exceptions from what I said above, but usually the consensus is that there should be at least 25 to 30% of institutional participation for the stock to be perceived as a sound investment and not just a short-term trade. Let's also look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price falls lower. Sometimes, if there are significant short interest in the total volume, it could be a sign that there is an organized shorting operation going on, like what has gone on. like what has been going on with GameStop and AMC. The current short interest is 6.5% of the total float and 43.5% of the dark pool transactions. Now, let's also take a look at the indicators. Financial indicators give us a suggestion of what the price movements are showing, and they can be used as one of the elements or factors to determine what should be done regarding a stock. The oscillators are showing 2 sell, 6 neutral, and 3 buys, with an overall tendency of neutral. The moving averages of the past price actions have 14 sell, 1 neutral, and 0 buy. The overall tendency from the perspective of the moving averages is strong sell. The moving average can be used to determine whether the stock is overbought or oversold compared to its previous price fluctuations, which may be used to see if the stock trade is sufficiently well timed. In terms of pivot points, which are levels of support and resistance sprinkled in the price trends, the support levels are $12.81, $15.78, and $16.82. For the resistance levels, they are $18.49, $20.87, and $25.13. Palantir has been having a fairly challenging sequence of events as of late, partially because it published quarterly results that were below people's expectations in one specific area, and that is the growth in public contracts revenue. As a result of this, some analysts decided to reevaluate their perception on Palantir's value and consequently triggered a chain of reactions among market participants. Another way of putting this is that people have been more reluctant at buying Palantir at the current price because the basis on which they evaluated that company's value has changed. So did the demand for its shares. Being a major public company with material institutional holdings, analysts' opinion do have a significance for those who handle money on a large institutional scale. In this case, the recent sell-off may have been created by the fact that institutional portfolio managers have seen the analysts having changed their consensus about Palantir, coupled with a relatively high valuation that the stock already has, to determine that they may not want to carry that much exposure in Palantir compared to what they initially predicted. This sell-off may have multiple causes, but in my opinion, the snowball effect began with the Q3 results, and then it triggered a chain of reactions of existing issues and concerns regarding people's uncertainties over Palantir's valuation, and has accelerated people's desire to reevaluate their exposure in the company. Palantir is valued based on future projections that were determined in a very favorable environment, and I would argue that this environment has become more challenging, at least for the medium term. I don't believe that Palantir necessarily has a bad business model, but its current valuation has already put so much hope and even hype on the shoulders of the company. And there is a very compelling case for the market to take a break on the buying spree. With that being said, Palantir has a software-based business model with deep and long-term relationships with various public and private sector clients. It is likely that eventually it'll make a more permanent mark in the private sector so that it can diversify its risks from solely relying on public sector contracts to both sectors. For that reason, I think that the long-term recommendation should be positive and to adopt an overall bullish view. However, in a market where the conditions are now more challenging for growth stocks, we also have to reconsider the timing and amount of exposure we're willing to put in Palantir. More specifically, it seems like Palantir has fallen below its long-term support of $20, and there doesn't seem to be that much support from where it is. We should consider waiting for the correction to be mostly behind us before committing more capital to Palantir. Our portfolio should be ready for the scenario that Palantir may pull back all the way down to $13 or even $10 before its support is reached. It doesn't mean, of course, that the company will necessarily reach that low point, and I don't see any signs that it will, but it's a matter of protecting our capital in an uncertain market environment. My suggestion is to keep an allocation between 3 to 5% in Palantir, and to buy in very small batches every time the price falls. The current price point suggests that it will continue to correct lower, and we should see within the next couple of weeks if new support levels can be found. In this current market environment, I believe that we should be careful about taking positions and risk in the financial market in general, and in the equity market in particular. Because over the past decade or so, the financial market has been living with the help of newly created capital from QEs, resulting in a massive increase of asset prices and the corresponding decrease in their yields. And the low interest rate also contributed to reinforce this phenomenon because the financial sector would see its profit margins reduced, and in turn keeps the returns of other sectors and employees low as well. At the same time, the market doesn't represent the real economy, and the real economy doesn't get reflected in the price of different securities. The market is a game of supply and demand, which will depend on a number of factors, not just the fundamentals. If the asset prices only depend on the fundamentals, then their performances in the Northern Hemisphere would have been more than mediocre, because things have been mostly stagnant over the years. A few things can explain why asset prices managed to remain high despite the stagnation of the underlying businesses. The first one is that over the years, there has been more money printed by different central banks to support their own economies. But because that money is distributed to banks and expected to loan to businesses to create more jobs, and that in fact there aren't that many opportunities out there, this money became capital that travels around the world and went into the huge financial melting pot. The QEs are now wrapping up in many countries, so I don't think that it'll remain as the main driving force over the next couple of years to keep the asset prices up. But it's compensated by the arrival of new capital from different regions to North America because it's perceived as a safe haven for investors. With the rising tensions around the world, this capital inflow will probably be sustained over the next couple of years, if not intensifying. The last phenomenon is the creation of artificial bubbles that are either supported by real market trends or completely fictional ones to allow market participants to play the game of hot potato and to either create profits or to safekeep their capital. The EV sector back in 2020 is an excellent example of this. But nevertheless, what it means for the market is that the degree of uncertainty is probably going to increase over the foreseeable future, as the expectation for a recession has been building up for more than a decade, and that the economic difficulties are accumulating around the world, especially from Asia. What this means for the market and for us is that the volatility is supposed to increase over time, which will provide opportunities to make a profit or to incur losses, depending on the timing and risk management. Another thing to note for this period of time is that we have to be very careful about having shorts. It's already riskier than having longs because the losses of shorts are not limited, right? Because there's no limit in terms of how far the stock can increase. But with the increased involvement of short sellers, I believe that the stocks being shorted will have an even higher probability of getting squeezed, which will result in potentially massive losses. So we're also observing more of an irrational behavior from market participants in the sense that very often people will choose to rush in a position not necessarily because the fundamentals are convincing, but because there's a buildup of demand in a specific stock and people will pile in to ride the gravy train with the rest of us. That kind of behavior is highly risky and may result in losses. It's worth pointing out that in 2020 and probably in 2021, the market has never presented that many opportunities, but it was also during that same period of time that many retail traders have incurred their biggest losses. A rule of thumb is that each position should be structured so that even if they don't succeed, they don't impact the portfolio's stability. Positions should begin small so that there is an opportunity to average down later. And specifically for the growth stocks, I think that 5 to 10% overall should be a healthy weight for the portfolio. And each stock should represent about 1 to 3% of the positions. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.